Coin Tracking Tax team. And first of all, I want to introduce you to our co-sponsor of this podcast or of this webinar, BitFi. BitFi is a well-established platform that has been operating for nearly 3 years. The platform provides a wide range of services and products like spot trading, derivatives trading, and documentary trading, creating a trading environment ideal for both beginners and professionals. And with that, I want to introduce you to our guest today, Clinton Donnelly from Crypto Tax Audit. Hi, Clinton. Could you please introduce yourself for our viewers?
Thank you very much, Moritz. I'm glad to be here. My name is Clinton Donnelly. I'm the president of CryptoTaxAudit.com. We're a full-service tax preparation firm. We do gain calculation. We use coin tracking as one of our primary tools. We do tax return preparation, which we have a bulletproof tax return methodology. None of our clients have been audited because of the methodology that we use. And we also offer a service called Audit Defense, which is basically car insurance for your tax return should you be audited. People can follow me at Twitter at CryptoTaxFixer. And we also have our website is Crypto Tax Audit. So
Okay.
I should say about me, I have a law degree in international financial regulations. I'm an enrolled agent with the IRS. I'm a certified criminal or cyber anti-financial crime specialist for cryptocurrencies. A lot of expertise. We have a very large company. We service clients all over the world. I have clients in 71 countries, including Taiwan.
That's very nice. So you are the perfect guest for our topic today. We are talking about crypto taxes in the US, how crypto taxation works in general, or how maybe crypto taxation fits in the general topic, taxes and paying taxes in the US. And of course, we will discuss some questions of our viewers, typical questions that come up since 2022 on a daily basis. But let's start at the beginning. Could you please give us just a brief overview about the taxation system in the US and crypto taxation in general?
Well, certainly. In the US, cryptocurrencies are considered property. They're not currency like a euro or a yen. It's actually property. Property is taxed in two ways. And this is brought out on the tax return. And people are doing taxes right now. There's a question on the very top part of your page 1 of the 1040 tax form. And it reads, at any time during the year, did you receive as a reward, award, or payment for goods or services, or did you sell, exchange, gift, or otherwise dispose of a digital asset or financial interest in a digital asset? So those two questions kind of lay it out there. It's a yes or no question, and all crypto traders should answer yes. It's far, far safer to answer yes than to answer no, because if you answer no when the answer should be yes, that's a fraudulent answer, and that sets you up for some later problems should you get audited. So the two ways you're taxed is if you're paid cryptocurrency by someone for doing work you did, or you sold a product and they paid you in cryptocurrencies, that's considered taxable as income at the ordinary tax bracket that you're in. It's fully taxed. The full amount is taxed.
Mm-hmm.
But once they pay you in cryptocurrency, now they pay you in Bitcoin. Now you're going to save that Bitcoin on a wallet, and at a later time you sell it for a profit. So that sale, you experience some sort of gain, hopefully not a loss, on that gain. At the end of the year, all your gains and losses from crypto trading, as well as other capital assets like stocks, are all added up. And if it's a net gain, then that's taxed. So it would be taxed at your ordinary income bracket. If it's short term, if you hold the asset longer than a year, it's taxed at a little bit lower rate. One key misconception, I think, Moritz, that many American crypto traders have is they think that when I go from one cryptocurrency to another cryptocurrency, that is not taxed. They think they're only taxed when they cash out for US dollars. And that's a big mistake. You're definitely taxed when you cash out the US dollars, But you're taxed when you switch from Bitcoin to, Litecoin to Ethereum. Every one of those hops is a taxable event. It has to be reported.
Ah, yeah, okay. So unlike in some countries, to be sure, there are just few countries where crypto to crypto trades are tax free, but in US we have a taxable event when it comes to a crypto to crypto trade as well as for crypto to fiat trades. Is that right?
That's correct. Even if you're going to a stable coin, it's taxed.
Yeah. Okay. That's very good to establish that at the very beginning. So we have taxable events when we trade any spot trades. And what about future trades or derivatives or some financial instruments in the crypto space? Or let's say financial instruments. How are they taxed?
The IRS or the Congress has not really issued specific laws on that. The general principle would be that when you're doing futures trading, you're experiencing daily gains and losses. And we sum these up at the end of the year. And if it's a net gain, that would be taxed as 100% short-term gain. When I say 100% short-term gains are taxed at your marginal tax bracket that the rest of your income is taxed at.
Yeah.
If you help, so futures do not get long-term tax treatment.
Mm. Talking about short-term and long-term, could you please give us the definition of what is a short-term trade and what is a long-term trade, and what are the results of what is the result of the taxation for a short-term trade or a long-term trade?
Oh, so if it's some asset is held a year or less, then it's considered short term. If it's held more than a year, it's considered long term. We're measuring it from the date you bought it to the date you dispose of it. Now, when you're using coin tracking software, there are several parameters in there that allow you to choose what's called the tax basis or tax method. Do I use when I decide which one I sell, and I can decide this after the fact, was it the oldest one I had or the youngest one I had? There's a number of tax settings on there. One that we would typically recommend is called HIFO, highest in, first out, which is generating the least amount of tax during the year as possible. So that's generally the best setting for that. And when things are taxed at short term, it's taxed at your ordinary tax bracket. Let's say it'd be like, for most people, it'd be 24 to 32% of rate. If it's a long-term asset, it's taxed at long-term rates, which are 15% up until your gross income hits about 500,000, and then it turns into about 20% tax. On top of that, you have another tax called the NIT, which is NIIT, which is 3.8%, so roughly 4%. So that's how U.S. taxation works.
Okay, and the tax rates are a result of matching these gains to the capital gains section. Is that right?
Yes. So as you make more money in the U.S., you're taxed at higher rates. It's called progressive system. Now, let's what if you had a loss? Let's talk about that situation.
Of course.
So, honestly, the U.S. taxation of capital gains is a little bit mind-bending, which is like a lot of the tax code. We separate the short-term and the long-term gains. We add all those up, and they come into a total for short or long. I said we'll call it short. So much for short, and then I have so much for long. A lot of people this past year may have had a lot of short-term losses. If you went in and the market was going down, you sold it right away, you had a loss. But you might have long-term gains. Yeah, you didn't sell it at the peak, but you bought it a long time ago. And though it's a down year, you made money. So I might have long-term gains and short-term losses. Well, how's that taxed? What we do is we look at the total amount. In this case, let's take the situation where I have my losses short-term are less. At absolute value, they're greater than my gains. Okay, so let's say I lost 10,000 and I gained long-term 2,000. What happens? I add those together. It's an $8,000 loss, and since there's more of it short-term, it's considered a net 8,000 short-term gains. That's all you're taxed on. The long term is washed out.
Yeah.
Now, here's the issue with U.S. taxation is that there is a limit on how much loss you can write off on your tax return. That limit is $3,000. So of that 8,000 loss that we just described, only 3,000 of it goes to reduce your taxable income, which is a shame. The rest of it, the $5,000 loss, is carried over to the next year. So in a sense, you already start the next year with a $5,000 loss. It's a bit unfortunate that it happens that way, especially if you experience severe losses. But I do want to highlight that we've talked with people who have had massive losses. They lost hundreds of thousands of dollars, and they don't have the money to really spend to calculate the gain, how much that loss was.
Yeah.
So they just say, well, just take the $3,000 loss. We'll prove it to later, another day,
Okay. But at least the rest of the sum is carried forward for the next years to, to match them or to calculate them with the gains of the year after, right?
Right, exactly.
Okay. So we covered the topic losses. We have also a few user questions about that topic, especially when it comes to lost coins. But let's push that a little bit more to the end. Right now, I want to talk to you about NFTs and how NFTs are taxed in the US.
There's two ways NFTs are taxed. It depends upon whether the NFT, whether you're the creator of the NFT or merely an investor with the NFT. If you're the creator of an NFT, then it's basically a business. You have worked to create this NFT. You might have had to buy a computer, some software, had maybe some development costs. You have costs. And then you sold the initial NFT for a certain price. In that case, you're taxed on the difference between the two is considered business income and taxed as a business expense or business income. Now, if you're the investor, you bought the NFT and you're holding it and you're marketing it and trying to wait for the price to go up. You're an investor. In that case, it's property, and you experience a gain or loss when you dispose of that NFT, and that's treated as a capital loss, just like other crypto trades.
Okay, so the general term token, whether it's a non-fungible token or a fungible token, is taxed on the same way in the US.
That's right.
Okay.
Yeah.
But with the exception of if you are have this business income by minting that NFT or producing that NFT of some way.
That's correct. Yes.
Okay. So when it comes to NFTs, most people also talk about play and earn and stuff like that, earning in games, and lots of questions relate to the taxation of this tiny transaction, tiny gains that I receive by playing, or how do they report that? What are the requirements for the reporting in play and earn, the play and earn sector?
Well, play to earn offers a little more complexity. There are a couple different ways that might happen. You might do play to earn where all the tokens are held, say, on they're ETH-based tokens. So it all shows up on the regular blockchain. You may have a situation where there's a private blockchain that's being used just for that game. Or you might be using a more like an Axie where it's a shared but special purpose blockchain. So there's a couple different ways that happens. Ultimately, the same principle is that you're taxed on the net gain or loss that you have from those transactions. The difficulty gets to be with play to earn games is that there's just so many transactions, often for small amounts. It's difficult. These services generally have horrible record keeping. I mean, I'm sure the people at BidFi put out far better records than these games do. You can't, all you can see is ETH was spent, ETH was received. You have no idea why. So it becomes extremely difficult or impossible to reconstruct matching what you bought and sold for. So an alternate way to do that is to just step back a little bit and look at that game as a big square. All right.
Mm-hmm.
I put some initial asset into it,
Yeah.
traded around, played the game, and then I took out that asset, maybe in one or more chunks. And we look at it from a box point of view, I can see, well, hey, I put in 1 ETH and I got out 2 ETH. So
Okay.
that whole thing was a net 1 ETH gain. And if you look at it that way, that can help simplify that complexity.
Mm-hmm. Oh, that's a very good example. Thank you very much. I was always thinking about how can I explain this to somebody, and that's a very good metaphor. So thank you for that. Okay. I think, yeah, play and earn is right now a very exotic topic when it comes to taxation. Maybe let's do something more general, something more obvious. Maybe, for example, let's talk about mining, staking, lending rewards. How are they taxed in the US?
Okay, let's start with mining. In the US, mining is considered a form of business, and when you receive the mined coin, that's considered income at the fair market value in US dollars on the date you receive the mined coin.
Mm-hmm.
So, it's not the value at the end of the year when you're doing your gain calculations, the day it's received. From that collective gains that you had mining, you can subtract your business expenses related to it. So, equipment, electricity, that's a big one, and equipment, electricity is pretty much the whole thing with mining. So
Mm-hmm.
that's how mining is taxed. Staking has some interesting challenge, although it's similar to mining. The nature of it's a little bit different in the sense that with mining, we're talking proof of work. Work is actually being done. It's understandable if that's a business.
Mm-hmm.
When we're doing proof of stake, we have a algorithm which selects your node to prepare the next block.
Mm-hmm.
So there's nothing really you did to earn that except merely being a participant. And then you run the program and generate the block and receive the reward that you get for that.
Mm-hmm.
So the IRS doesn't really have clear guidance in a lot of areas with cryptocurrency. It's almost every time the IRS says something, they shoot themselves in the foot. I will say that, actually, they're a little bit smarter than the SEC. And it's probably a good thing that they haven't, because really cryptocurrencies had a chance to emerge and flourish without crushing burden of tax. But when
Yeah.
we get to stake, the IRS general position is the same as with mining, that you experience income at the fair market value in US dollars on the day you receive the staked tokens. So that would be the thing. Now, I will say that there is a group of people that disagree with that. So this is an alternative viewpoint, just to be straight up with everyone.
Okay.
And there's a consortium called the Proof of Stake Alliance, which is putting forward court cases to push the IRS to clarify this. And their argument is, hey, wait a second. A staked coin or token is something that is created. The tax law says in section 61 that gross income from whatever source derived, that's the key tax phrase here, from whatever source derived. Well, hey, a staked token is not derived from anything. It's created. Much like a baker bakes a loaf of bread, is he taxed when the flour comes out of the oven as a form of a beautiful loaf of bread? Is he taxed for income then? No, he's taxed when he sells it. A car company buys all sorts of parts, assembles a beautiful car. Are they taxed when it comes off the assembly line? No, when someone buys it. And this is their argument, is that staking rewards are created assets and should be taxed when they're later sold. All right, not at the time of receipt. And there's, just to say, that's a minority viewpoint. If you get audited, you can fight it. You might have to go to tax court to prove your case, and proof of stake alliance might help you, but just let me know about that one. Lending. Lending is, first of all, is that clear about staking? How staking is taxed upon receipt, just to be clear about that.
Yeah. I guess that was established, yeah. But it was established as well that we have there, a conflict between opinions, like almost everything in crypto. And yeah.
Well, exactly. A lot of people have issue being taxed when they haven't experienced any income. That's the rub. So in the US, and this is probably a point we should have made earlier, everything is expressed in terms of US dollars on the tax return. People say, oh, hey, I went to ETH. How can you tax me? No, well, what was the value in dollars at the day you went to ETH, right? And this is where the coin tracking software helps put that together for people. That we can talk about lending. With lending, there's a couple things happening. There's lending and then there's borrowing. So when I lend to a service, I'm trying to think of which one I'd use. They're all out of business, but like, let's say I lend to BlockFi, all right? And I put some money on or coins on deposit at BlockFi. I then receive some rewards for that. We call it rewards. IRS, we call it interest. And that interest is considered taxable in US dollars on the date it's received. There is, so that's the lending. The borrowing side of that might be, you might lend it and then you might borrow from your own amount that you lent. So let's talk about that scenario. Okay, so I put in $10,000 worth of some coin, and then I borrow back out from that $5,000 worth, which I then invest. Okay, is there a tax on the borrowing? No, because it's not really your money. It's not a gain to you. So there's no tax on having borrowed. So I borrow it. I borrow 5,000. I invest in some other asset here, and it goes up to 6,000. Whereupon I sell it. But it's with borrowed money, right? Yeah, it doesn't matter. You experienced a gain, so that $1,000 gain is a taxable gain to you. You then have some coin which you received when you sold it at 6,000, and you use that to pay back the $5,000 loan. Okay, so paying back the loan is not a taxable event. Making $1,000 with it is. Now I've paid off the loan. The loan's paid off. There's no tax on that. I take my money out of the BlockFi, which you should have done, and there's no tax on taking your money back. But let's talk about the scenario where I put the $10,000 worth. I borrowed $5,000, and then the price collapsed on my initial investment, and I trigger the contract which says that they're automatically going to liquidate my initial investment. So let's say they liquidate my initial investment because it hit. I'm not sure how they do this. Let's say it hit 5,500 and they liquidated it.
Yeah.
I borrowed 5,000. They liquidated at 5,500. I get 500 back or whatever the difference is. That it was liquidated, that they did it, doesn't matter. It's still, you experienced a sale. So there's a taxable event when they liquidated your investment.
Yeah.
You may have bought that for $2,000, moved it there on now 10,000. They're holding it. They liquidated at 5,500. You may have tax to pay on their liquidation of that event. So that's an exposure that people would have.
Okay, but to be sure, most of the time when some of those contracts or those positions get liquidated, it was because of a loss in some case. So if I experience that loss as I experience this liquidation as a taxable event, and with that taxable event, I realized a loss, for example. So this loss could be, calculated against my other gains.
Right. So let's say for $9,000, you bought the asset that you put on deposit. At the time you put on deposit, it was worth 10,000. Price then collapsed down to 5,500, and the service liquidates your initial asset. So your sale price, your purchase price for that asset's 9,000. You sold it for 5,500. So the difference would be $3,500 would be your net gain. So
Yeah.
There is tax on that.
Okay. Okay. So be careful about liquidation limits, I guess, when it comes to lending protocols and borrowing protocols and stuff like that. Thank you very much for the information about those topics. Yeah, to summarize everything, mining and staking rewards are taxed as income with my progression rate as regular income, not as capital gains. But there is a major discussion about staking and staking rewards and everything about staking protocols that will continue maybe for a few years, right? So that's about that. And let's continue to with airdrops and forks. So we received some airdrops due to some information we provided, some Twitter tweets we retweeted, or something else, or we have a fork of a blockchain and receive some new tokens from the new project, blockchain that evolved out of the old one. So how is the taxation in those cases? Let's start with the airdrops, please.
Airdrops are considered taxable events for your receiving income. They're taxed at their fair market value in US dollars upon the date that you receive them. Most of the time, these airdrops are trivial or insignificant or have no value, but it is considered income upon receipt, and you would report it as other income on your tax return.
Okay, is there any case where airdrops are non-taxable?
No.
No. Okay, that's a little bit different to Germany, for example, or UK as well. We have two types of taxation from airdrops, depending on whether you provided us a special service, whatever a service might be, to the protocol. For example, you retweeted some stuff and did something else, but the single connection of your wallet with the platform isn't a service, and therefore if you receive some airdrops just by connecting your wallet, that in most cases that's not considered as a taxable event in some European countries.
It's we do have a separate distinction, but they work out to be the same. So let's say you had a faucet that was giving airdrops, and again, the full value in US dollars that you receive it, that's considered income. If I had actually was being paid as a service, which you talked about earlier, the tax amount is the same. The full value in US dollars to fair market value in US dollars at the day you receive it is still the amount that you're taxed. So they're the same, even though the reason they're taxed are different.
Okay, thank you very much. Then let's continue with forks. Is there any difference between hard forks, soft forks, or is there anything to know in general about forks?
Well, the IRS took a position early on that hard forks, where the protocol changes resulting in a second coin coming out, that would be that when you receive that second coin, that is a form of income, and it's taxed at its value in fair market value US dollars on the date it's received. Now, there's a lot of challenges to that viewpoint because on the day it's received, it has no value. No one's ever sold one.
Mhm.
So fair market value is defined as the price at which a willing buyer and willing seller would agree upon, both possessing all information. Well, there were never any sellers the day the coin's issued. So how can you assert what the price is? It
Mhm.
is very much like an IPO, the first day purchase of stock. We have no idea what the price is.
Mhm.
So that is a counter opinion that's out there, but ultimately you pay tax on everything. So it's whether it's now or later is the question.
Mhm. But the new coin isn't valued at the same market value like the other chain, if the chain still exists after the fork.
Well, like we had back in 2007. I mean, there aren't too many hard forks like there used to be. 2017, the classic hard fork of Bitcoin Cash happening. Bitcoin, at the time, Bitcoin was in the 10,000 plus range. Bitcoin Cash came out, and its day one price was in the $200 to $300 range.
Mhm.
The price eventually settled down to a much lower price over time. So, there's some that's the debate. Yeah.
Mhm. Okay.
But basically, the IRS position is the day you receive it, that's the value. There's certainly some subjectivity in terms of what that day one value is.
Do we have some issues if the tokens are locked in some way, that they are not tradable in any way, and we don't have any price history for 2 months or something, and then the token gets unlocked and on the market, and then we have some price action?
Well, that's a great question, Moritz. We have a topic called constructive receipt. So that I have tokens, but they're not in my possession. They're locked up via maybe a smart contract, or they're locked up. They won't be released to me until some event happens. And we have constructive receipt, section 1.451-2 of the tax code. And it basically says an asset is yours if with very little effort you can take possession of it. Okay, so it's the rewards are out there. You just have to do the transfer onto your own blockchain, and those are considered constructively received when they were put out on the other blockchain. All right, so just because you didn't pick up the money doesn't mean it's not yours. So on the opposite side, if I have to completely liquidate an investment position before the rewards are sent to me, then that is not constructively received. And although I am accruing these rewards, they're not mine until they really do get released to me. So there's this idea of difficulty or inconvenience that separates when these things are constructively received. This is very important when you get into smart contracts and how a lot of those operate.
Okay, but that's as far as I can see it right now, that's a single case decision every time, right?
Every case is different, and software like coin tracking is not going to be able to pick that up. You're going to have to, if you're the one doing the work, you have to understand what's happening, when's that event occurring, when do I want to be taxed.
I guess that's a very good point to mention, that it's always good to talk to a tax attorney, get professional help in any case when there's some difficult issues with some coins, or whether I have some gains or losses or anything else. And it's a very difficult issue, especially when we have some major discussion about the taxation in general with the IRS, for example, when it comes to staking or the forks, right? So could you at this point just give us a brief overview how somebody can get help if he needs a tax attorney or somebody in the crypto space?
Well, absolutely. There certainly. I'm glad to be talking to everyone listening. You can call me. You go to our website, cryptotaxaudit.com. Up in the corner, you'll see private consultation. You can schedule a private consultation, and we can talk about your specific situation, which is oftentimes the issue. I will say this as general advice. When you trade on multiple exchanges, there can be a tendency to have transaction records lost. Even moving, if you go to DeFi, even moving between wallets, we can lose transaction records, which makes it difficult sometimes to decide what the purchase price was, the initial purchase price. So you could be using a service like coin tracking, and you might find yourself at a position where, it's saying I made this much money, but I don't believe it. And hopefully you've listened to some of the general concepts to know what is taxable. But I will say this, that deep down in here, I think once we understand the general principles of taxation, you have a gut feeling of how much you made. I made somewhere in this range. I had a client called me up, just like you're describing, Moritz. He called me up and he said, and he was a higher volume trader. And he said, Clint, I'm using this other service. It wasn't coin tracking. And he said, they're saying I made $100 million. And I said, there's no way. I don't, I know big numbers are all zeros. He said it was closer to, what do you think you made? He said, it was between 40 and 80 million. I said, that's nice to have that big a range, isn't it? So, but I said, well, look, 100 million is not right. It's not right. All right. Just because you boiled up a bunch of numbers doesn't mean you got the right answer. So it turned out that what was your gut feeling? He said, I think he said 40 to 80. I said, it sounds like you made 60 million, more or less. He goes, yeah, I'd believe that. We actually did the calculation. He had a lot of transactions, a lot of DeFi transactions, and we actually came up to that 61 million. So that's, now I'm talking millions. That's funny to talk about millions, but just cut off a couple zeros and that's your position, and it's real money to you. So that's what I'm basically saying is if you don't believe the number that's coming out, don't file it on a tax return. File a number, even if it means you have to, even if you have to do some guessing to get to the finish line, you need to do that to get to a number that you believe in. If you believe you made a certain amount of money and you reported all of that on the tax return, you're going to pay a fair amount of taxes that you believe in. And most of the time we can come back and defend you if you get audited on that. So, which is what we do in our audit defense. First thing we do when we defend somebody in audit for the IRS, we completely recalculate the gains. And that's what the IRS talks to, our recalculated amounts, not the ones that people initially put forward. So we have a very high success. We've done about over 40 audits with the IRS, and we actually get refunds at about 30% of the time, mainly because we're much more aggressive at calculating than other people are. So
that's very good. That's very nice. When it comes to taxes, I always recommend to do it at the best knowledge and the best will you got first, and secondly, don't be stupid. Do the calculation. In that case, he saved a lot of money. If he had filed for 100 million, that would be at least like 10, 15 million dollars in tax payment, right?
That's right.
That he saved. So be smart and calculate it on the best way and on the right way, and talk to a professional if there are any unknown issues with the taxation of some coins.
And the converse is true here. If he'd done the calculations and come up with an answer, he only had $10 million worth of gain, and he said, "Oh, I like 10 million. That's nice." If he filed that on his tax return, he knew inside here that was a wrong number, and he's underpaying what he believes, and even he himself believes would be the right amount of tax. If he got audited that big a difference, and if they found out that he didn't believe the original numbers, then that would start to expose you to a tax fraud situation. So report a number you believe in. I mean, because oftentimes you might be the only person who really understands what that was.
Okay, thank you very much, Clinton, for that short overview about why should somebody do their taxes. Okay, to sum it up a little bit, we already talked about spot trading, future trading. We talked about NFTs, play and earn earnings, mining, staking, lending, airdrops, forks. Why should somebody file their taxes? And we teased it already at the very beginning. And now maybe we have to switch to a little bit sadder topic, but let's talk about lost and stolen coins, especially when it comes to exchanges that fall apart. What can I do with my losses? Can I calculate them in any way, or do they help me in any way with my taxes?
There's several different ways that happens. And if we look at the situation of, I bought a coin and there's a rug pull, right? The workers, they're not trying anymore. It's just a dead coin. In which case, you should, the IRS just came out with a advice that you should at least try to sell it when it's gone to nothing. If you can't sell it, if there's no buyers, then at least you tried, and you want to save documentation that you tried. Generally, in that situation, what we do is consider that a worthless investment, and you basically write it off as though it were sold for $0 at the end of the year. Okay. On December 31st, it genuinely needs to be worthless, and it's never coming back. You just can't, just because it went down, it's now down to 50 cents, and you don't like that price, doesn't mean you can write it off if it's still a valid entity, a going concern, as we would say. It has to be truly abandoned and worthless. Secondly, what another type of loss would be if was a capital loss where I lost money. That's a capital loss. You can't change its nature. What about a theft? And with a theft, presents certain complexities. You have to prove that something's stolen. I've talked to people who said, I was sitting there on Coinbase and I could watch my balance being drained because somebody else had gotten access to my Coinbase account and just drained it while I was watching it, and it's really, first of all, it's difficult to prove that that was happening, that you weren't the one taking it. Coinbase can't support you in any sort of way with that. So it's really difficult to prove, A, that you had a loss, who it was that took it, and did they have a criminal intent? It wasn't just your brother trying to take some coins out of your account. So
which could be criminal intent as well.
yeah, that happens. So it's difficult to prove theft. However, the IRS came out with a special treatment. They call it, it was basically a criminal fraud treatment, or sometimes called Ponzi loss. It's not a true Ponzi, but any type of criminal fraud loss. In this case, you might as well rename this the Sam Bankman-Fried procedure. So what happens here is, if the promoter of the investment, in this case, Sam Bankman-Fried, if they are indicted by a federal or state government or a federal or state agency with criminal with financial crime, then that is considered prima facie evidence that there was a criminal theft activity, and you can now write that off as a theft loss. Theft loss are, and I'm sorry, this is going to be a little bit technical for you, but it's considered an itemized deduction. So in the U.S. tax code, you have income, which includes your capital gains, and then you get to subtract off your itemized deductions. These deductions are kind of like lifestyle deductions. There's a standard amount, which is roughly $13,000 per person, $26,000 if you're married. But if you had like a big loss, let's say you lost $50,000 on FTX, and this would be loss in the terms of, well, I shouldn't say FTX, that's kind of reopened, I think. But you invested in some coin that went away, so it's a genuine theft. So in which case, you can treat that as the itemized deduction. It would be greater than your standard deductions, and then you can deduct that from your taxable income to reduce your taxes. The key here is you have to be able to itemize. So if you just had small losses, it isn't worth the effort. It's the Ponzi scam treatment. The way you complete it is by filing the Part C of Form 4684, and that then the bottom line amount goes to your itemized deduction. What do you get to deduct? You get to deduct the amount of money you put into the investment, not as cost basis, but the amount of money at the time you put it in, any amounts that you withdrew, so that the rest is defines how much you lost. You get to claim a 75% deduction on that. If there's a chance of some recovery through bankruptcy or legal action, if there's no recovery, then it would be a 95%. We've had a number of these this year. We've had FTX. I'm not sure if people lost things on FTX, but it might have been the coin, the FTT coin. You may have invested in BlockFi. BlockFi had depended on they were defrauded by Sam Bankman-Fried via Alameda Research because they depended on an investment of $250 million from Alameda to stay afloat. When that became obvious that was non-existent money, BlockFi collapsed and shut down. So if you lost investments on BlockFi, you would be able to claim that 75% reduction. Because there's a chance of bankruptcy proceedings, you might get something back. You can't take the 95%. What about Celsius? Celsius, people lost a lot of money on Celsius. And the story isn't completely out whether Sam Bankman-Fried had a hand in that. But the operator, Alan Mashinsky of Celsius, was indicted in January of 2023. So since the indictment occurred in 23, the IRS would recognize the loss as a 2023 loss. Okay. So any amounts that you had there, we can't write it off for this year, 2022's taxes, but next year's 2023 taxes, yes, you could claim 75% on that.
So to be sure, 75% on the money I put in, minus the money I deposit, withdrawal.
Total amount that went in, and, you had your initial deposit and other amounts that you put in, minus any withdrawals you made. All of this is in fair market value of US dollars, which leaves a certain amount that is your total loss amount. You get to itemize the deduction 75% if there's a chance of further recovery from bankruptcy or lawsuit.
Okay.
If none, then you're at 95%. I'll give you an example of none. You invested in Luna or US Terra, UST, right? So that is an example of something you're not going to ever get that money back from. So that'd be a 95% loss. Now, there's a little bit of debate on this, and you can probably play it both ways. Is that a 2022 loss or 2023 loss? The SEC, that's a government agency, indicted Do Kwon in 2023. So it's definitely at least a 2023 loss. Do Kwon claims that Sam Bankman-Fried had a hand in bringing down the Luna coin in 2022. Well, Sam's already been indicted in 2022. If that claim can be, substantiated, you might call that a 2023 loss. Either way, you'd prefer it 22, but worst case, it's 23. Depends on how aggressive you wish to be. So this is sadly is a loss. Now, these are itemized losses. They're not capital losses. They're not reductions off your capital scenario.
Mm-hmm. Okay. Yeah, like you already said, afterwards, at the very end of your tax formula, then you can enter the lost amount.
Yes.
Okay. And just to be sure, you and your company, you can help people who lost a lot of coins or anything in those protocols from a legal perspective and in any way, right?
Yes. Crypto tax audit has made its name taking on the hardest of cases and the most complicated cases. So we have very large and very large clients as our customers. We've had clients with 5 million transactions, clients with 75 wallets, 20 exchanges, guys that felt like it was their job in life to experiment with every single blockchain that there was. So, we have been able to do all of that. So we have our own in-house accountants and forensic analysts who can calculate the gains on all these services. And we are extremely innovative, and we're aggressive, and we do what nobody else can do, quite frankly.
That's awesome, especially if you lost a lot of money. Great. Okay, Clinton, I think we are running out of time soon, so let's just skip to a few follow-up questions. Let's start with the first one. What can be considered as a tax evasion and how to avoid it? I guess we're talking, yeah.
So we're talking about how do I avoid evasion? It's by confronting it, right? Hey, look, we have it's a voluntary tax system in the U.S., which means your honor is on the line when you file a tax return. That to the best of your ability, it's accurate, true, and complete. Now, if you knew that it was not accurate, well, let's say I don't want to focus on accurate because there's a little bit of we're not always sure what the exact number is. We talked about that, but as long as you have as long as it's reasonably complete, reasonably accurate, and that you can good conscience sign it, then you're doing it on the right path. Evasion occurs when you're not reporting it. So let's say you made money on a foreign exchange and you say, hey, IRS would never learn about this. I'm not going to report it to them. That would be a form of evasion or fraud. So we have two laws in the U.S., tax fraud and tax evasion. Certainly small mistakes, nobody's going to go to jail over things small. However, the threshold that is $10,000 of hidden income is enough for the IRS to have you sent to jail. They're not typically going to do it for a small amount like that. The key is to be compliant. If you knew what you were supposed to do and you don't do it, then you're into an evasion road. All right. And tax fraud is similar to evasion in that I'm reporting it, but I'm being deceptive. So the penalty for tax fraud is $250,000 and 3 years in prison. For tax evasion, it's $250,000 and 5 years in prison. So these are pretty similar, but prison is not something you ever want to do.
No, I guess not.
I had a client who went to jail before he met me. He didn't report all his crypto income. He hid it. Without getting into the details of that, he hid it. He didn't trade it on a public exchange, and the IRS discovered this. They dusted his wallets with Satoshis, and now every time he trades, the IRS can see it. And that's how they proved that he had not reported income. What happened was the two guys with guns and badges showed up at his door, and they wanted to interview him, which he eventually went down for an interview, and they explained this, and they gathered data. And after about a year, he got a call from the Department of Justice district attorney informing him that he was being indicted for tax fraud, and he received the indictment. At that point in time, and this is very important for people to realize, and this is also a way the IRS is going to be doing more of these attacks. They don't have to prove how much your gain is. Everything we've been talking about up till now, we've been talking about how much is the gain, right? With tax fraud, all they have to show is that there was $10,000 of income that you didn't report and that you intentionally didn't report it. And now what happens once you get the indictment, it's what we call a plea bargain. Now you're just talking to the attorneys about, well, how long am I going to go to jail? It's not about how much do I owe. It's how long. You still have to go back and file the tax return and make it correct. If you don't, they can still hit you with the audit. But he went to jail for about 6 to 7 months. That the penalty, though, is not just that risk, but when you are sentenced for a crime that's more than a year, it's considered a felon, and you're a felon for the rest of your life. It's not just 6 months, but it's the rest of your life. He's prohibited from working in the financial industry, any high-tech, high-security industry, military. He's really, and the rest of his life, whenever he fills out a job application, he has to check that box. Have you ever been indicted for a crime? It's a stain on his reputation for the rest of his life. And as he said, Clinton, he said, if I get pulled over by the police for going a couple miles an hour over speed limit, and he pulls my driver's license, sees that I'm a felon, the likelihood that I get away with just a warning from the policeman is very small. I'm going to be hit with. There's just no tolerance. That's the rest of his life. So what we're talking about here is very serious. And anyone that's in a fraud, Moritz, a lot of people don't realize they're committing fraud or tax evasion. They didn't know what the tax laws were several years ago. And they misfiled 3 years ago. 2 years ago, they misfiled. This year, they realized, oh, I misfiled those previous years. But if I go back and report in 20 and 21 how much money I made, it would destroy me. And so this year, if I say yes on the virtual currency question, the IRS will find me. So they continue to hide. They continue to go down this we call it a rabbit hole of just ugliness until at some point in time you're discovered, right? I mean, and I want to say this: we've made a big plea for tax amnesty. The government needs to give tax amnesty so that we can bring people in. I believe roughly 15% of the U.S. population is in this situation to some degree, and we need tax amnesty. And if you have a situation like that, you should give me a call. We'll talk about your situation. Okay.
No, sorry. I was just referring to your how many percent of the US population has those kinds of problems, and I was just saying that maybe 80% of the crypto people are in that same situation because they didn't think about taxes at all by trading or doing this stuff, right?
It's exactly right. Yeah, it's a major thing. We need tax amnesty. We've come up with a website. Today I sent a letter to the IRS commissioner just pleading him to come out with tax amnesty. They've done it before for foreign accounts and some other programs. We need it for crypto people. They're good people. There are some criminal type out there hiding and money launderers, but good people who got tripped up by the enthusiasm and didn't understand the laws, and now they're being driven into a tax fraud, tax evasion lifestyle without ever wanting to be there. And they need a way to come in and get clean again. So we need tax amnesty. We've created a website, taxamnesty.org, and we invite everyone to go there, read about it, contact your senators and congressmen, and ask them for tax amnesty.
That's a very good service, and I guess that will help a lot of people. A lot of people who made some money in crypto, but also everybody else who can, take it as an example or something and work out his problems for themselves, for example. But yeah, as we already mentioned, you and your company are there for everybody who has those kind of problems. Okay. If you want to, we can just do one last question from the community, and then we will be done for the day, I guess. So, how does the IRS treat initial coin offerings, ICOs, from the tax perspective?
Well, initial coin offering, it depends on what investment you put in to get those coins. If you're an earlier investor, you basically, whatever coins you got, the initial amount you invested is your cost basis. That's your purchase price. And then when the coin is issued, it's not income to you at that time because you've already bought it for some certain price. If you got it for free, then the airdrop rule applies. So with initial coin offering, it doesn't matter what the price is until you sell it. And then when you sell it, you experience some sort of gain that you can report that will be added to the rest of your capital gains.
Okay, that was a little bit lighter question at the end. I think it's a good point to stop right here. Thank you very much for the interview. I think we have covered a big amount of information for everybody in crypto, and I think it helped a lot of people. Thank you so much, Clint.